Hello everyone, this is CA.Tejeshwini Chiranjeevi. In this video, let's try to understand about the amendments. So that is this amendment applicable for May 26, Jan 26 and Jan 27 examinations. And this whatever we are looking into is for AY 26-27, that is PY 25-26. Last year we had studied about PY 24-25 and AY 25-26. This video we are in this year, we are going to study about the amendment which is applicable for May 26 examination, September 26 examination, and Jan 27 examination for CA students. And for CMA students, it's going to be June and December examinations. Okay. So the first amendment which has come up is in the first chapter, that is basically the introduction to the direct tax. It is 115 BAC. What this 115 BAC speaks about is nothing but the default tax regime of the Income Tax Act. All of us know there are two regimes, that is a normal tax regime and the default tax regime. This normal tax regime, we speak about we also call it as optional tax regime, and default tax regime, this is covered under section 115 BAC. What is the changes that we can see is that in AY 25-26, this was what was applicable, and now this is no longer applicable. AY 26-27 is what applicable now. That is up to 4 lakh, it is nil. From 4 lakh to 8 lakh, it is 5%. 8 to 12, it is 10. 12 to 16, it is 15%. 16 to 20, it is 20%. And 20 to 24 lakh, it is 25%. And about 24 lakh, it is 30%. Okay. Remember, whatever we have studied in AY 25-26, that is not applicable. That is which was applicable for AY 25-26. It is not applicable now. So please quote like this, or you can just give it an individual quote also if you are comfortable. Whatever is comfortable, you can do this. Okay, this basic material, whatever you can see, it is available in my Telegram channel. You can get a copy of it. Okay, see, up 4 lakh rupees, it is nil. How to remember this is very simple. You just have to take 4 lakh as the difference. Start with the 4 and get the difference of 4 in each slab. 4 to 8, the difference is 4. 8 to 12, the difference is 4. It is just the multiplications of 4 here. And how to remember the percentage up to 4 lakh, however, you have the basic exemption limit, it's going to be nil. And above that, it is going to be 5%, 5, 10, 15, 20, 25, 30. So, remembrance of this is very easy. AY 25-26 had a problem, that is you had a difference of some 4, 3, 2 and then 2 and 2. Now you don't have all such problem. It is just that 4 lakh you'll start with, and then you'll take the difference of 4 and 4 and 4. And for the remembrance purpose, you'll just take a nil for basic exemption limit. 5, 10, 15, 20, 25 and 30. That's it, done. Okay. So this is about the changes which is very, very important in your examination, whichever you will be writing. Suppose it might be May, June, or it might be September or December examinations, whichever you will be writing. This section is always a hot topic for the institute. Okay, all these points, like how I've framed this entire material, that is amendment material, is that wherever, whichever section we have the changes or the amendments in, I've just taken out from my main material and I've given the complete information of that entire section. And wherever it is amended, I have highlighted that in red so that you can verify and you can mark it as amendment or whatever it is, wherever you are feeling comfortable with. Okay, so let's look into one example for this AY 26-27 calculation of 115 BAC. So this is illustration 3 from the chapter 1 from ICI material. Mr. X has total income of 25 lakh, that is for PY 25-26, comprising of income from house property and interest on FD. Compute his tax liability for AY 26-27 under the default tax regime under section 115 BAC. See, this question, why we are doing is to understand how the calculation of this AY 26-27 is going to be affected to. Okay, up to 4 lakh it is going to be nil, and 4 to 8 we know what it is. The difference is 4. So we have taken 8 lakh. Out of this 8 lakh, 4 lakh is, however, basic exemption limit is available. So we are just subtracting this 4 lakh from this 8 lakh, and then we are getting the remaining as 4 lakh. And the percentage which is applicable for the first slab is, remember, 0, nil, that is nil for up to 4 lakh rupees, it is nil. 5, 10, 15, 20, 25, and 30. Based on that remembrance, we are doing this question. Okay, try to recall the concept when we are doing this question. 5%. So 4 lakh into 5%, it is 20,000. So the next slab is again the difference of 4. Keep the 4 multiplications, keep the 4 tables in mind. 8 lakh. After this 8, it's going to be 12, right? So the difference from 8 lakh to 12 lakh, that is nothing but 4 lakh. Out of 12 lakh, see, I'm trying to tell you here in a very detailed manner. Out of 12 lakh, you've already considered 8 lakhs. So the difference is 4, right? So 4 into 10%, it is 40,000. Again, 16 minus 12. 12 you have, up to 12 you have already considered. Difference is 4 into 15%, 60,000. Similarly, you will do for the next. 16 to 20, it is 20%, 80,000. 24 to 20, difference is 4 lakh. The slab rate which is applicable is 25%. So 1 lakh you have considered here, right? So then how much is your income? How much is Mr. X income? It is 25 lakh. Out of 25 lakh, up to 24 lakh you've already considered. So the difference is only 1 lakh, right? So 1 lakh into 30%, that is going to be 30,000. So how much is the total tax that you are paying? 3 lakh 30,000. From that, you're always going to add HEC no matter what. So HEC 3,30,000 into 4% if you do, you will get 13,200 and the total tax liability is 3,43,200. Clear? I hope it is clear. This is how you are going to do the calculation. It was a simple question which I have taken from the chapter number 1, Introduction to Direct Tax from your CA material, illustration 3. Okay, see, this is the amendment which is there for AY 26 and 27 from this section 115 BAC. Okay, rebate for resident individuals from section 87A. Whenever there is changes in the main sections or the main provisions, automatically we'll get these changes. Remember, rebate will also be changed. For default tax regime under section 115 BAC, earlier the income, total income, if it was less than or equal to 7 lakh, rebate was available up to 7 lakh. You had tax liability, that is, you had rebate which was given under section 87A. But 7 lakh is being replaced, and now you have how much as rebate? 12 lakh as rebate. How much is the rebate? 12 lakh is the rebate. How much is the rebate? 12 lakh is the rebate. Okay. The total income, if it is less than or equal to, see, you can see here it is also equal to. If your income is exactly 12 lakh, will you get the rebate? Yes. Would you need to pay any tax over there? No, you will do the tax calculation, but you will give rebate of 87A and close. Okay. How much? Suppose if it is 11 lakh, you will get rebate. 10 lakh, you will get the rebate. What if this is 12 lakh 20,000? Rebate is not available. See, rebate is available for the total income less than or equal to 12 lakh. It is not like 12 lakh 20,000. I'll get rebate of for the amount of 12 lakh. For the 20,000, I need to pay the tax. No such concept. If your income is 12 lakh 1 rupee also, you have to now pay the tax for entire 12 lakh 1 rupee. It is not that you will have to pay the tax only for that 1 rupee. Come on, not possible, right? So, rebate under section 115 BAC, the total income is less than or equal to 12 lakh, you will get the rebate of the entire tax payable. That is nothing but the income tax payable or 60,000, whichever is lower, lesser of. So, if you use a basic point here, if you are able to use it, till what amount do you have the rebate for up to 12 lakh? How much is the tax payable maximum you can get if you are paying it up to 12 lakh? Obviously, it is 60,000. No, that is how you are ending up with the 60,000 rupees in the provisions. 60,000 is max what you get under 12 lakh rupees, or your income tax payable, whichever is lower, will be considered as your rebate which is available under section 87A. Okay, a very important provision as well. Remember. Optional provision, however, it was 5 lakh and still same 5 lakh rupees prevail over here. Now, I'll ask a question. Is this rebate applicable for resident individual? Yes, it is applicable. What about non-resident individuals? For non-resident individuals, remember 87A is not applicable. Non-resident, that fellow came from California for the first time and is settling in India. He is a non-resident. His status, residential status is non-resident. So for his income, will he get any rebate? No. What about the company which is a resident company? Will you get rebate or obviously it is no. See here, this rebate is for resident individuals only. Not even HUF can take it, not even firm can take it. This rebate is only for resident individuals. Clear? So now with regarding to this domestic company earlier the provisions was for AY 25-26. If the turnover in this particular year, if it is less than or equal to 400 crores, it is 25%. See now what the changes that AY 26-27 has bought into is very simple. If your total turnover or your gross receipts in PY 23-24 is less than or equal to 400 crores, how much is the total income? 25% of the total income will be your tax payable. What does it mean? See, every year this particular point gets amended. Every assessment year or the previous year, you can call it for your reference, will get into amendment. What amendment? AY 26-27 means it is going to be AY 26-27 means PY 25-26, right? People, we are looking into the amendment video. So the basic understanding of how I'm teaching is that you already know the provision. You're just looking into the changes that has happened. Okay. And we are studying it in a very brief manner so that you need not have a point of how the amendments or how the questions would be. So that is the intention behind this video. PY 25-26 means you have to go backward for another 2 years. Go backwards. This is going to be PY 24-25 and PY 23-24. This year you are catching in for the purpose of PY 25-26. See, if you consider the similar point over here, PY 25-26 means it is going to be PY 24-25. Now go backward for 2 years, it is going to be PY 23-24, PY 22-23. See, again, we have got backwards too. Whichever PY you are studying for, whichever AY you are studying for, okay, take that particular year's PY and go backward for 2 years. You will get this provision. Understood? I hope you have understood. Suppose if you are writing for your CA final, obviously in Income Tax Act, which is applicable from 1st April 2026, you don't have the concept of AY and PY, so that is going to be different. In this particular point, I hope you have understood. AY 25-26 means if you are confused which year turnover to take in, just use this logic. Take that particular, this year is the year which you are writing your exam in. Take that year's PY 25-26, go backward for 2 years. 23-24. See, you need not even remember, just remember the logic here. PY 23-24, if your turnover is less than or equal to 400 crores, this one you have to remember, okay? There is no other option, there is no logic which is involved, it is just that 400 crores. If it is less than or equal to 400 crores, you have to pay 25% of the total income as your 25% is your tax rate applicable basically for that matter. In any other case, it is 30%. However, it was prevailing the same in the previous year also. That is in the preceding the P1. That is in the last AY also you had the similar point. There is no amendment which has come up to in any other case. The amendment is there in only for this 25% slip. 25% tax rate. Okay. PY 23-24, if it is less than or equal to 400 crores, remember it is 25%. Nothing else. No rocket science or something. Very simple. PY 23-24 less than or equal to 400 crores. How much is the percentage? 25 is the percentage. Clear? So now let's get into another amendment which has come in salary chapter. Okay, income from salary. See, earlier in 17(2) subsection 2 clause 3, it spoke about the perquisites, which is taxable in the hands of specified employees only. And this perquisite, all of us know what is meant by perquisite. It is a non-monetary compensation, not a monetary compensation. Non-monetary in nature. What is non-monetary? If you are getting a allowance, money, monetary benefits for staying in a house, that is HRA. If you are getting the flat only from the organization side, that is your monetary benefit, sorry, non-monetary benefit, that is nothing but perquisite, rent-free accommodation. All this concept comes under the perquisites. See, you might be getting a tickets for some concert or for some stadium, for some cricket match or something from your organization side at a discount price. That is also a purpose. If you would have paid from your pocket, you would have paid some 4,000. But in organization, because you're getting from an organization side, you are getting it just at 500 rupees. So 4,000 minus 500, 3,500 is the perquisite which you are getting from the organization side. Clear? Now, perquisite which is taxable only in the hands of the specified employees. And now, why this section becomes important for your exam is that because of the definition of the specified employees which has been amended. Okay. Whatever you can see in black, it is something which is there in the previous assessment year also, this year also. Whatever you can see it in red, only that has gone under changes. Okay. Earlier, the definition of the specified employee was director employee, employee who has this interest, substantial interest in the company. That is basically is carrying 20% or more of the voting power in the company. And this employee, which he was drawing in excess of 50,000 rupees was what the definition was. But now you can make these changes. This 50,000 rupees, whatever you can see, is now being amended with prescribed amount. Okay, the act says prescribed amount. But what is that prescribed amount? Information is there in this rule 3. See, this was just for your knowledge purpose. You need not remember this. No knowledge purpose only. Prescribed amount is now how much? 4 lakh rupees. Okay. See, I'll tell you very quickly. Section 17 subsection 2 clause 3 speaks about whatever the non-monetary benefit, that is perquisites, which were these 5 perquisites you can see in the hands of the specified employees only. What were those perquisites? The company providing the domestic helpers, basically sweeper, gardener, watchman, personal attendant, etc. Giving free utilities like gas, electricity, all this amount is paid by the employer. See, all this supplied by the employer. Offering free tickets, that is free or discounted tickets. Allowing the company employee to use the company owned car, or providing free or the discounted educational facility. If these services are being provided by employer to employee, and this employee is coming under the definition of the specified employee, only then this was considered to be a taxable perquisite. What if these services are provided but not to the person who is coming under the specified employee definition? It is not a taxable perquisite. Clear? Now, who is a specified employee? Director employee, the person who is carrying 20% or more of the voting power in the company, or the employee who's drawing the amount. This is not in excess of 50,000. Now it is 4 lakh. Please cancel, strike that 50,000 and you can replace that with 4 lakh, however it is provided here. Okay. See, an employee other than an employee described in 1 and 2, basically apart from these two people, if there are other employees coming under the category 3, and the income which is chargeable under their salary, basically their salary should be exceeding how much? Should be exceeding salaries exceeding the prescribed amount. What is it? Exceeding the prescribed amount. That is nothing but how much? 4 lakh rupee is a specified employee. Clear? What is the amendment? All this amendment topics which you can see, it's going to be very, very important for your exams. Okay, based on this and only majority of the questions or the concept will be picked for your upcoming exam. So please be careful. How much is this replaced with? 50,000 with 4 lakh rupees. Okay, MCQs also you can get options, the chances are there. Okay, this is the one important amendment. You have an amendment in the medical facilities also. This is also a perquisite wherein the employee would be getting certain benefits from the organization side, like the reimbursement. He might be getting the reimbursement of health insurance paid. He might be getting the treatment in the employer's hospital. All these points comes under the point of medical facilities. Okay, but the amendment has come up in the point wherein the medical facilities is being given by the employer to employee, not within India. There is no amendment for within India. The amendment is there outside India. That is expenditure on medical treatment outside India for employee. Okay. See, earlier, what was the medical treatment? Whenever a person is traveling outside India, it might be for the purpose of medical treatment. Okay. He requires a travel expenses, hospital expenses, and the stay expenses. These are the three main expenses which will be incurred. So, medical treatment of employee or his family, stay or the travel abroad for the medical treatment, or stay and travel for the one company, one attendant accompanying the patient. These three expenses, the employer is bearing those for the purpose of employee. Earlier, there were certain deductions, that is, there were certain exemptions given. That is, okay, the employer is providing so much, employee is taking the benefit, let's not make certain purpose it as taxable. And there was a point wherein the travel expenses for the patient and the attendant are exempted. Okay, if this employee, this fellow for whom the treatment is taken, or for his family member the treatment taken, that fellow employees, if GTI does not exceed 2 lakh was the point earlier. Now this 2 lakh has been replaced with the prescribed amount, and that prescribed amount as per the rule is 8 lakh. What you need to remember is very simple. The travel and the expenses of the patient and the attendant, only travel expenses are, we are not speaking about the medical expenses, and we are not speaking about the stay expenses. We are speaking only about the travel expenses. Okay. The travel expenses are going to be exempted if the gross total income of that employee is doesn't exceed 8 lakh rupees is the point which you need to consider over here. Okay, remember 8 lakh, 8 lakh, 8 lakh. Earlier it was 2 lakh. The amendment is 8 lakh. So the next amendment is an income from house property. Okay, there is only one amendment in this. We knew the SOP properties, we can consider up to two properties as SOP, and automatically the third properties would have been DLOP, right? There is one amendment that has come up with which will help in the practical life situation also, wherein now the self-occupied property or the unoccupied property, and the definition of the unoccupied property has been changed. This is the actual amendment. Okay. Earlier, all of us know self-occupied property, the annual value was nil, and this benefit was available for individuals or HF, and there was no deductions for municipal taxes. We knew all of this. The amendment has come up with the definition of unoccupied property, wherein they state, see, unoccupied property refers to a property which cannot be occupied by the owner. It might be the reason of he having employment in some other place, business or profession at a different place, and he resides at such place in a building not belonging to him. Basically, he might be having a property in Bangalore. Because of a work situation or employment situation, now he has shifted to, let's consider, Mysore. Okay. So it's not possible, feasible for him to stay in Bangalore and work in Mysore every day. He can't go to and from the organization just because he's having a property in Bangalore, right? So what he does, he gives the property in Bangalore for rent, the entire building for rent, and he goes and stays in a rented place in Mysore. Now, these sort of situation happens. Okay. Now, what he can do is that this is the one house which he has given it for rent, and he is staying in some other place for that. This one house, even though he has given it in rent, just because it is coming under the definition of unoccupied property, wherein the property which cannot be, if he was having a business in Bangalore, he would have stayed in Bangalore only. No, he wouldn't have gone to Mysore. So, because of the reason for employment, business, or profession at a different place, and he cannot reside at such place in building, which he cannot reside at this place and is staying in some other place over there. If it this is the situation because of which the definition of unoccupied property is coming in, then he can give this property. Remember, even though this one house is given it on rent also, still this particular house can be considered as your SOP for that matter. But this is practical situation I'm telling you. Theoretically, what it says is that this property, whatever is getting, for exam purpose, I'll tell you now. This property which he is not staying in. Okay. And it is left as unoccupied. That is, this no one has come up in this situation. No one is there. He has not given it on rent. In this situation, what he can do is that he can call it as unoccupied property, and he can consider it as self-occupied only. Okay. The first situation which I told was a practical situation. Okay. Theoretically, which is applicable for your exam, is very simple. One property is there, and you are not able to stay in this property because of some business, employment, or profession in some other place. You can call it as SOP property. Earlier provision stated that automatically, if this property was not occupied, even though you were not receiving rent also, it was considered to be DLOP. Now you can call it as SOP, and you can have two properties. However, you can call it as SOP. This property also, now you can legally call it as SOP property. Okay. Hence, only if a person owns more than two houses, the additional house will be treated as DLOP. This is the one amendment which has come up in income from house property situation. Okay. See now, deductions from GTI. There are certain changes which has been made in the capital gain, but we will speak about the capital gain later. Okay. Now let's try to understand about the deductions from GTI. What does the amendment is which has come up in section 80 CCD 1B? Whatever the limit which you had for 50,000 rupees, it is as it is. There is no such changes. 80C, 80CCC, 80CCD 1, including these three sections included, it was 1,50,000, and 80 CCD 1B, you were getting 50,000 rupees extra apart from this 1,50,000, that is additional 50,000 you were getting. If you have invested your money or contributed this money to the national pension scheme, which is notified by the central government, right, which is outside 1,50,000, wherein the restriction was there in under section 80 CCE for this 1,50,000, it is also outside that 50,000 you were getting. This is what the section 80 CCD 1B meant earlier. Now, what is the changes which you are getting is that there is one more option which you can take in now. What is it? The contribution. Earlier, you were supposed to make the contribution for yourself only. Now, you can make that contribution to a minor child's national pension scheme account, and this can be done by a parent or a guardian under the national pension scheme Vatsalya Yojana. Under this Yojana, you are contributing this national pension scheme for your child, for the minor child, or you being a guardian to that child, legal guardian to that child. This also, you can now get the income tax deduction under section 80 CCD 1B rupees 50,000. That is the amendment which you have got in this. Okay. So now the next point comes under the provisions for filing the return of income and the self assessment. What is it? Section 139.88, wherein we are speaking about the updated return of income. What is the section? I'll just tell you in 2 minutes. You are supposed to file your return under section 139.1. All of us know that, yes. You come under certain limit, you have to pay the, that is, you have to file your income tax return. That is, your income exceeding the basic exemption limit also, you have to file your income tax return. Even though you're not falling under tax bracket, still you have to file your ITR. You forgot to file your ITR within the due date mentioned. That is, you forgot the actual due date, you forgot the belated return due date also, and you have the time has been lapsed. Now you need to file the return like a good citizen of India. You want to file your return of income, or for some other situation like you want your loan to be approved, or you want to go outside India where ITR is mandatorily asked. Now you are filing the ITR. That is the time wherein you will start filing your 139.80. So now tell me, just use the common point. You have filed your income tax return like a good citizen within the due date. Now, the belated return, or sorry, the revised returns due date has been gone. Now you want to revise it. If you are going and telling the government that I want the refund, my refund which I've asked for is, let's consider 50,000. Now I want my refund to be 60,000. Will the government allow? Obviously no. But if it is the reverse the case, my tax liability which I paid is 50, Now I want to show my tax liability as 60 or my turnover more. Can the government allow that? Obviously they will allow. Yeah. The reason behind bringing this only so that the government gets the extra tax liability. Sorry, the government gets the extra income from their side and we get the extra liability, or we can show the extra income. That is what the intention is. So 139.8A, remember, if you want to show your loss return, you can't file. If you want to show less tax liability, you can't file. If you want to show the less sales, that is also not possible. You can't show this. Or if you want to increase your refund, increase your refund, that's also it's not possible. So 139.8A basically it's a updated return of income wherein you can show wherein you can pay more tax or a wherein you can go for lesser refund for that matter. Earlier, the person could have filed this within 24 months from the end of the relevant assessment year, right? That is from the end of the relevant. Suppose let's consider AY 25, 26, 20, 26, 27. Uh, so let's do one thing. I'll just take an example. AY 24, 25. Let's take it. Okay. From the end of the relevant assessment year, earlier it was within 24 months. Okay. This year, AY 24-25's due date I've closed. The PY which was applicable was 23-24, right? This is closed. The due date for that year is closed. But now you're thinking, I want to file this return for AY 24-25. Now, you can file 139.8A, but you have to look into the due date, right? You can look into the dates for the section. That is, what is it? Within 24 months. 24 months means 24-25 is the AY. 25-26, 26-27. You had the time till 31st March 2027 to file your return. Now it has been extended to 4 years. That is within 48 months. 48 months is what? It's your 27-28. Now you can file. Imagine, yeah, it's a very beautiful point which they have given. If you failed to file your income tax return also. Now we have an option. AY 24-25, that is PY 23-24, 31st March 2024 is written. Now you can file till 31st March 2029. It's an advantage section only, no? So now they have removed this 24 and they have brought in 48 months. That is the amendment which we are speaking about in section 139.80. Okay, remember, it is very important for your MCQ. 24 months has been replaced to 48 months from the end of that relevant assessment year. Okay. So now next section 140B, there is a amendment in your tax liability payment that you are making. Okay, tax on this. Basically, this updated return of 139.8A, you have just seen the point, right? On that section only, the tax point also they have updated. What is it? Before it was only 24 months, so the provision was only till 24 months. Now it is 48 months. So now they have to increase the penalty also, sorry, the additional income tax payable also. Earlier, if the tax was supposed to be paid under this particular section of updated return, that is 139.8A, after the due date of the belated return or the revised return, whatever the return you can call it as, but within 12 months from the end of the relevant assessment year. Let's take the same example. A by 24-25. Okay, A by 24-25, it's completed. B by 23-24, 31st March 2025 is done, but you want to file your return. Within how many, within after the due date of this belated return due date is done, revised return due date is done. But within 12 months from the end of the relevant assessment year. Okay. How much is the tax payable that you're supposed to take? 25% is the additional income tax. Suppose you're paying 100 as the income tax, you have to now pay 125 if you're coming under this particular timeline. Okay, you have to pay how much? 125. What if you are thinking, okay, and now I need to file the return after 12 months, but within 24 months from the end of the relevant assessment year? Look into the timeline, people. So here, 31st March 2025 date is gone. Now you want to file the return. Let's consider in 25-26. Okay. Within how many months? Within 12 months from the end of the relevant assessment year only. No, let's consider on 1st of August you need to file your return. This is within the 12 months timeline. So now if you're paying 100, pay 25 extra, you have to pay 125. Suppose now you're thinking this in 26, 27. That is August 2026 you're thinking. This has come up to a timeline of after 12 months. This was within the bracket of 12 months. Now this is 12 to 24 months bracket is what this is coming up to. After 12 months, but within 24 months, now you are not paying 125, you are paying 150. That is 100 plus 50. 100 is an example which I have taken. Okay, just for the purpose of consideration, I'm taking 100, and this 50 is the additional tax which you are paying. So now let's consider the next timeline, that is 24 to 36 months timeline. If you're taking, you're thinking of filing the return for AY 24-25, the return which was applicable or supposed to be filed for AY 24-25. Now you're thinking, no, I want to file that particular return. But the timeline is coming up to after 24 months, but within 36 months. So now you are paying 160. 100 plus 60% as the income tax plus whatever the interest payable. That basic calculation you will do, interest payable calculation. What if you're thinking after 36 months, but within 48 months for that matter, we are thinking this in A by 28, 29. This is like a late realization which will happen in life. Later on, you have realized, okay, I have not filed the return for EY 24-25. Now, like a good person, I need to file the return for this. So, what is it? 36 months within 48 months. How much is it going to be? 170, right? 100 income tax basic, which I have considered, plus 70, plus interest, whatever you're supposed to pay. Okay, this question becomes important for MCQ. You can expect a question from this section in your MCQ. Chances are there. Okay. So I'll quickly summarize whatever has been written here. Within a period of 12 months to 24 months after the end of the relevant. What is your relevant assessment year in my example 24-25? You can take this one example. So what you will do is that you will pause video after this. A by 24-25 is what I've taken. You do it for some different A by. You take it for A by 26-27 or you do it for A by 25-26. You do this similar exercise, you will get the clarity on the topic. Okay. Within 12 months to 24 months, 25%. 24, sorry, 12 to 20, within 12 months for that matter, 25%. 12 to 24, 50%. 24 to 36, 60%. 36 to 48, well, 70%. How to remember this? There's a difference of 12 months over here, and it is starts with 25, increases to 50, then 60, and then 70. 50, 60, 70, it goes in a sequence. Just remember 25 jumps to double time 50 and then 60, 70. This is how we will remember. Okay. Right. So now let's get into a very important discussion, that is your TDS and TCS. A lot changes has happened in this particular section and it is very important because minimum 4 marks weightage, or they can sum up sometimes go up to 6 marks also in your exam. Mandatory questions comes from your TDS TCS topic. Don't ignore the amendments which has happened, because majority of the time the TDS TCS concepts are asked on your amendments only, so you have to be 100% confident. Okay, if possible, please try to take the printout of this. Whatever material you can see, you can find it in my Telegram channel. Those who already have it, very well good. Please take the printout of it and keep it for your ready reference. So whenever you need to look into the amendments of for that matter, just take it, have a quick glance of it, or if you want to recall it, watch the video, and then you're done with the amendments. Okay, great. Section 193 speaks about interest on securities. So wherever I've highlighted in red, that is the changes and that is the part which we would be discussing. We will not be discussing the entire sections. Okay. So earlier, the threshold limit for the section 193, basically it is interest on securities. And the earlier, the threshold limit was earlier the threshold limit, and now the threshold limit is changed, that is to 10,000. The amount or the aggregate of the amount which is exceeding rupees 10,000 rupees during the financial year, the section 193 is now applicable. What if this amount is 10,000, exactly 10,000 rupees? TDS concept itself is not applicable, because It is exceeding more than 10,000 is what we call this. This is section 193. Section 194 speaks about the TDS on the dividend amount which we would be getting. Earlier, the threshold limit was 5,000 rupees. Now, one payment which you're getting or the aggregate of the amount during the year which you're getting for, if it is greater than 10,000, that is which is basically exceeding 10,000 rupees in one particular financial year, it is going to be section 194 will be applicable and the TDS would be deducted. Section 194A, that is interest other than the interest on securities. Earlier, see, this provision has no point with regarding to the applicability. Sorry, amendment with regarding to the applicability. Now there is amendment for non-applicability of this TDS. When exactly this 194A is not applicable is that if your interest paid or credited in an year from bank, cooperative societies or the post office for the specified deposit scheme. For certain specified deposit scheme, if you were getting interest from the bank, cooperative societies or the post office and that amount is how much? If it is exceeding, if it is under 10,000 rupees, there is no TDS. To keep it simple, if you're getting interest from the specified deposit scheme from bank, cooperative societies and the post office and that amount is 8,000. Will you get any TDS under section 194A? Will 194A be applicable? No, total it is not applicable. What if this is 11,000? Yes, it is applicable because it is exceeding 10,000. No. The non-applicability, if it is under 10,000, up to 10,000 rupees, it is not applicable. If it is beyond 10,000, obviously it is going to be applicable, right? So, up to 10,000 rupees, 194A is not applicable. Beyond exceeding 10,000 rupees, section 194 is applicable. However, this particular limit of whatever I told you, 10,000, is higher at 50,000 rupees. And for senior citizen, it is going to be 1 lakh, wherein the payer is going to be so much. Okay. See, basically, this section says that if these banks, cooperative societies are being paying the interest for this particular specified deposit scheme, it is not going to be 10,000 being their limit. The limit is going to be how much? 50,000. And for senior citizen, it is 1 lakh. See, whatever I've cancelled, this is the previous year. So that is the relevant preceding the previous year. We can simply call it as last assessment year. Last assessment year was the point. Cancelled out means now it is going to be not applicable. That is, there are some changes in the figures over there. Suppose if the person total interest paid or credited is not bank, is not cooperative society, it is not post office, it is some NBFC for that matter. For them, the limit is 10,000. For these organization, for this particular specified deposit scheme, it is going to be 50,000 for normal individuals and for senior citizen, the limit has been increased to 1 lakh up to it where TDS 194A is not applicable. Okay. Suppose now the cooperative society basically need to deduct the tax for their members for paying the interest. It might be for their members. This applies to the members of the cooperative societies also. See here, if the cooperative society is paying to another cooperative society, okay, basically it is paying interest or it is paying to their members also, whatever it might be. If one cooperative society is paying to another cooperative society or to its member, basically the interest they are paying. If it was supposed to be taxed, if that interest which they are providing, if the TDS is applicable under section this 194A, you need to satisfy two conditions. One is that the sales which is happening within the cooperative society which is paying the interest should surpass, that is, should exceed. Their sales should exceed 50 crore in the last period, that is the relevant, that is for the last assessment year, plus the interest what they are paying should exceed 1 lakh if the member is a senior citizen or 50,000 rupees for others, for non-senior citizen or for the other cooperative society. Interest which is paid should be exceeding 1 lakh in case of senior citizen member, or 50,000 rupees in case of other member on the cooperative society. Plus this interest which is being paid by this cooperative society, that particular society should be doing good. Doing good means the sales should be exceeding how much? 50 crores. Only in that case, this concept of cooperative society, they need to deduct the tax. If any one condition is not, it's not satisfied, because you can see here it is plus and clause, not or clause. If any one condition is not applicable here, then automatically you will not pay. You will not be liable to deduct the TDS under section 194A. Here we are not speaking about the taxability, people. Here we are speaking about whether TDS is applicable or not. That's the important point. Okay. This is your section 194A amendment of 50,000 rupees replaced by 1 lakh, and 50,000 rupees replaced by this 40,000. Okay. This 1 lakh has been replaced in the place of 50,000. This 50,000 has been replaced in the place of 40,000. So if you can just look into this proper material, you'll be able to get the point. Okay. Section 194B, that is TDS on dividends. What does this point of TDS on dividend means? See, your threshold limit. This is section 194B. Again, this is for mutual. This is not 194B TDS on dividends. This is tedious on winning lotteries, winning from horse games or horses. Okay, this is not tedious on dividends. Okay, great. Some typing mistake. Section 194B, wherein the nature of payments is winning from crossword puzzles or the crossword games, etc. You please, if you have this material, please cancel out. This is not tedious on dividends. This is winning from lotteries. Okay. This nature of payment basically speaks about if you have won from lottery, gambling, or any other sort of games, not online, only offline, this sort of games. Herein, the threshold limit earlier was 10,000 only. Now, this point or this sentence has been replaced here. Amount or the aggregate amount was stated, but now this amount in a single transaction is what been replaced with. If it is greater than 10,000 rupees. Now, this is in a single transaction. It is not only in a financial year. So, the amount in a single transaction, if it is greater than 10,000, yes, then this section 194B TDS need to be deducted. TDS need to be deducted. Clear? Next is section 194BB, wherein winning from horse races, the same. Section 194BB is the brother of 194B. So, it's going to be similar adjustments have been considered. The amount, aggregate of the amount in this place, in single transaction is been replaced. Amount in single transaction, if it is greater than 10,000, then 194BB is applicable. The section 194D, which speaks about the insurance commission which you are paying. Earlier, if this commission is less than 15,000 or if it is not exceeding 15,000, it was exempted. If it is exceeding 15,000, you were supposed to pay TDS for that. That is, TDS need to be deducted. Then only you are supposed to pay the remaining amount. Now this 15,000 limit is increased to how much? 20,000. 15,000 or 20,000. The person who is receiving it was taxable or not. It depends on his individual income status. But for the purpose of TDS, earlier if it was exceeding 15,000 rupees, the commission payment which I am making to someone, I need to deduct the TDS. Earlier it was 5% and then I had to make the remaining payment. Now, if that commission which I am paying to that fellow, if it is exceeding 20,000 only, I need to deduct the TDS. And the TDS amount is how much? 2% for a non-corporate resident, nothing but a normal individuals for that matter, 2%. And for the domestic company being a insurance commission agent over there, we need to deduct 10%. The amendment has come up in two places in the section 194D. See, 194G speaks about commission on sale of these lottery tickets, wherein the commission or the aggregate of the amount which is greater than 20,000 rupees is considered as your, that is, TDS need to be deducted. You are paying commission on sale lottery tickets. It is 18,000. Do you need to deduct any TDS? No. because it's not exceeding 20,000. And how much is the rate applicable now? Rate applicable is only 2%. That is, you are supposed to deduct the 2% TDS and then pay the remaining amount. Okay. 194H, which speaks about the commission or the brokerage. What is the changes has happened in two places? That is, the rate is how much? 2%. Commission or the brokerage, if you are paying, if you are coming under this applicability point. This applicability point, detail it will be explained in the TDS TCS videos. So you can watch over there. If this section 194H is applicable, how much is the rate that you're supposed to deduct the TDS at 2%? And how much is the amount again? 15,000, it is replaced with 20,000. So if it is exceeding 20,000 only, you will deduct the TDS. If it is not exceeding 20,000, you will not deduct the TDS. Section 194I. See, earlier, this is very important section, and also the changes in section 194I is very important. You are paying rent, and whenever you are paying the rent, you have taken the plant, machinery, equipment as a rent, you were paying 2%. You were deducting 2% and you are paying the remaining 98% you are paying. If you have taken it on land, building, etc., it was 10%. Right? So now whatever the deduction which you are doing, earlier, if it was exceeding 2,40,000 rupees, only then you were deducting TDS. If it is less than 2,40,000, you were not deducting. Now there is a changes in this provision which becomes very, very important point. Okay, what is it? No TDS is required if the rent paid or credited for the month or part of month is less 50,000 or less. They told don't deduct the TDS at all. Okay, TDS, the section 194I is not applicable for you. If you're per month you're paying TDS, sorry, per month you're paying the rent of 50,000 rupees or less. Equal to 50,000 or less if you are paying, or don't deduct. Yeah, that is very small amount. If it is more than that per month, yes, please deduct and pay. That is what section 194I. Section 194J, which speaks about the professional and the technical services for in you were deducting. This is also very, very important because earlier there is no changes in the rates, okay, rates of the section. There's only changes in the threshold limit in this particular assessment year. Lot of tedious changes you can see in the threshold limit. So for technical services, if you are paying 50,000 or more, if the payment individually or for one particular year you are paying more than 50,000, then it is not liable for deduction. Sorry, less than 50,000 not liable for TDS deduction. If it is more than 50,000 only, TDS deduction necessary. Professional charges also. Earlier it was 30,000, now it is increased to 50,000. Commission, that is whatever you can call it as, you are paying it to a director. Even if you are paying 1 rupee also, you are supposed to deduct 10% on that. Okay. Non-compete fees, earlier it was 30,000. Now, if it is excess of 50,000 only, you are supposed to deduct 10% TDS. Royalty in the nature of this cinematographic films for that matter, again it is 50,000. Royalty, any other royalty for that matter, it is 50,000. Okay. You please cancel out this point. This is not relevant. Okay, only the threshold limit point because we have already given the threshold limit separately. That's some type of this. Okay, section 194M. M is the mixture of commission, brokerage, and the fees for technical services, contract services for that matter. The section 194M, what is the change is that rate of 2%. Now, section 194M, if the TDS is applicable for you, you are supposed to deduct how much? 2% of that. 194K, similar changes in the threshold limit, but it is 10,000. Earlier, it was similar to TDS on dividends. Basically, this is for mutual funds for that matter. If it is greater than 10,000, yes, TDS is supposed to be deducted. Section 194LA speaks about whenever there's a compensation which is given on immovable property for that matter. That is basically you are selling your property and you are that is immovable property and you are getting the money on that acquisition, right? That amount or the aggregate of the amount for that matter, if it was earlier, if it was greater than 2,50,000, section 194 LA was applicable. Now, if it is greater than 5 lakh only, this section of 194 LA would be more than 5 lakh rupees only, then it is going to be applicable. If it is less than 5 lakh rupees, the section 194 LA is not applicable. So tell me one thing, this 194 LA, is it applicable for normal sales or is it applicable only for the government mandatorily acquired property? It is going to be only for compensation or enhanced compensation on compulsory acquisition of immobile property only. Suppose you are normally selling that property, immobile property. This section 194 LA is applicable? No. Some other sections are applicable. With section 194 LA, remember, mandatory acquisition is happened by the government, and now we are getting compensation or enhanced compensation on that. And that amount which you are receiving from the government, if it is greater than 5 lakh, only then the section is applicable. If not, the section is not applicable. Okay. 194Q, wherein there is a purchase of goods which was greater than 50 lakh in a previous year for that matter. The section 194Q, there is a change in the other points, that is in the other category. Earlier, this section of 194Q was not applicable in two situations, wherein in any other section, this points which is covered here is already being taxed, or the tax is already collectible under section this 206C apart from this section. Now, the provision is that other than the section 206C, 1H is being removed over here from here. Okay, this is the amendment which is being considered in 194Q. Clear? So, there is a new section which has been inserted, that is section 194T. Okay, this becomes a very, very important point because the section itself is new. So, the chances of them asking is high. Section 194T, the nature of payment which is involved over here is salary, remuneration, or the bonus or the interest, whatever you are getting as a part. Threshold limit is sum or aggregate of sum where the amount which you are getting is greater than 20,000. This a payer, the person who is supposed to make the payment is any person being a firm. Now, this is specifically applicable for a firm, and you are paying to whom? Your partner. The firm is paying to a partner the salary, remuneration, or the commission, or the bonus, or interest, whatever the payment, and that payment is exceeding how much in one particular financial year in one transaction, or the aggregate of the total amount which you are paying is more than 20,000. Then you have to deduct the TDS at the rate of how much? 10%. You means being a firm. Firm should pay the TDS of how much? Deduct the TDS of 10%. It can be at the time of the credit of such amount to the partner's account, including the capital account also, or at the actual time of the payment, whichever is earlier. This is whichever is earlier, WE. Okay, whichever is earlier, you're supposed to get the payment. Whichever is earlier, you're supposed to deduct the TDS and pay to the government. Clear? 206C, that is the tax collection at source. The amendment over here is with regarding to the rates, which was 2.5% earlier. That is 206C speaks about the TCS to on the sale of certain goods, not on all the goods, only on certain goods the TCS is applicable. That is alcoholic liquor for human consumption 1%, Tendu lives 5%. The amendment has come up in these 2 points in the section 206C, that is earlier, it was only timber. The sale of certain goods included timber. Now, along with this timber, any other forest produce not being a tendu lease, not but being this particular tendu lease, which is obtained under the forest lease for that matter. Earlier, the TCS was 2.5%. Now, the TCS is only 2%. Okay, the timber other obtained by any other mode other than three. Apart from these three, apart from the third point, if there is timber which is obtained by any other source other than the forest source for that matter, still the TCS which is applicable is how much? 2%. Earlier it was 2.5%, it is cancelled and now the rate is 2%. Wherever the changes is, it becomes important. And the forest produce is also being defined. That is, forest produce means which is having the same meaning as in any state for the time being in force or in as per the Indian Forest Act. As per the state, whatever they have considered forest produce, whatever they have defined the forest produce as, the same definition goes along with in the income tax as well. Or as per the Indian Forest Act, whatever the definition of forest produce is, the same thing is being recorded over here. Okay. So 206C1F, that is sale of motor vehicles of value exceeding 10 lakh. You can also include now any other goods. Earlier it was just a sale of motor vehicles of value exceeding. Now the motor vehicles in the last year they have mentioned motor vehicles or any other notified goods from which wherein the whatever the value of that goods or the notified goods or that motor vehicle, if the value is exceeding 10 lakh, then the TCS of 1% should be collected by the buyer, right? Now, any other notified goods has been properly defined, that is wristwatches, art piece, antiques, paintings, sculptures, collectibles, coins, stamps, vehicles, transport, yachts, boats, and helicopters, sunglasses, bags, handbags, and purses, shoes, sportswear and equipment, home theater systems, and horses specifically for racing or polo. If the notified goods are coming under these points for that matter, then if the value is exceeding how much 10 lakh, then 1% of TCS need to be deducted. Sorry, TCS need to be collected over here. Remember, these points becomes important in MCQs as well because they can ask in descriptive questions also, MCQs also with this points. Okay. The next changes has happened in section 206C1G. This is also a TCS section wherein the remittance has been made under the liberalized remittance scheme of RBI or wherein you are purchasing the overseas tour package. See, there are certain remittances if you want to make outside India that happens through this LRS scheme which is given by RBI. Or if you are purchasing some overseas tour package, you are going for some trip or vacation for that matter, and you are paying this. Okay. And you are taking the tour package here. That purchase and the remittance which you are making that is covered under section 206C1G. How much is the TCS that need to be collected? Okay. The first amendment in this particular section is they have removed the term outside India. See, when is this section applicable? You being an authorized dealer who receives amount under the LRS scheme, you are an authorized dealer under RBI and you are receiving amount under LRS scheme for the purpose of remittance. Earlier, this outside India was there. Now, this outside India word has been caught up from a buyer being a person remitting such amount outside India. That is basically when you are remitting outside India has been cancelled. It means now in India or outside India, wherever you are using the LRS scheme is what they are mentioned. Okay. And again, you being the seller of the overseas tour package, you are the person who's dealing in this overseas tour package. People are coming in, you are giving the overseas tour package. For you also, it is going to be applicable. Okay. These people has to collect the TCS. This is what the section 206C1G means. Now, there is some rate changes and the threshold limit changes. Okay. There are basically there's a threshold limit change that has come up with. Previous year there was rate changes. Now there is threshold limit changes. Okay. See, if you want to remit, let's consider your son, your daughter, your wife, or your husband, or your children, whatever you can call it as, your family member, someone is studying outside India means you have to remit amount to that particular account, put to their account for them to pay the fees or for them to survive over there. So, if the amount is remitted outside India through LRS scheme, and the purpose, how did you remit that amount? Did you have your own amount or did you buy or did you go for loan? In the first situation, you are remitting the amount outside India for the purpose of education and you are remitting such amount out of the loan obtained from the financial institution wherein it has been defined under section 80 for the higher education for that matter. You are leaving amount outside India and it is approved and you can take the deduction under section 80E for that matter. In this case, what it is? Nil. Okay. In this case, there is no TCS which is in collected. If you are remitting outside India, through the loan amount, you are remitting that, you have taken the loan and you are remitting that amount for education purpose outside India out of the loan, then the TCS, no TCS need to be collected. And first of all, you are a poor fellow. Papa, you are taking out the money out of loan and you are giving it to your son or daughter. Moreover, if the government is also asking TCS on that, hey, you pay TCS on that, that's not fair. So they're telling no, will not collect any TCS. Fair enough. for the purpose of education or medical treatment, but now you are a rich fellow. You have not taken out any loan, you are paying from your income. Then, if you are paying up to 10 lakh rupees Indian money equivalent, then there is no TCS. Okay. If you are paying amount in excess of, that is one time you are making the payment, or through the entire financial year you are making the payment excess of 10 lakh, on that excess amount you are paying 5%. Earlier the limit was 7 lakh. This 7 lakh has been amended. Now that 7 lakh has been replaced by 10 lakh. Clear? Wherever I have caught it, it means that is not applicable. It is not applicable. Clear? This has been amended. The amendment is 10 lakh. And if you are making the remittance for the purpose other than mentioned in point 1, if you are now remitting not for education and you are remitting not for medical treatment also, in that case, up to 10 lakh, however, it is not that. Excess of 10 lakh. See, this is also not 7 lakh, this is also 10 lakh. Now, okay, please make the changes. Please make the changes. It is not 7 lakh, it is 10 lakh. That is 20% of the amount or aggregate of the amount in excess of how much? 10 lakh for that matter. Amount paid for the tour for the purchase of this overseas tour package over here. It is 5% up to 10 lakh and 20% above 10 lakh. 5% up to 10 lakh and 20% above 10 lakh. Clear? I hope this is clear. Now, here you can see there was no TCS up to 10 lakh, but this point remember there is 5% to 10 lakh, 20% about 20, about 10 lakh. Why is it so? And first of all, you are going for tourism purpose, that is tour package. You are going for vacation, you are going for some refreshment. It means if you are going outside India for the purpose of refreshment, means you are some rich fellow, you are not a poor fellow over here. So then you pay TCS also. You will be ready to pay TCS as well, pay TCS here also. Okay. See, for refer page number 7.87 in your material, that is ICI material, wherein they have given multiple scenarios with regarding to this section, so that you will understand more about this section. The section 206 CCA has been completely removed from your syllabus, and it is not there in the act also. This section itself is omitted. Okay. Now let's get into the capital gain. See, people, this capital gain, I'll tell you where exactly the amendment has happened. And also, there were a lot of amendment in the last year. That is in PY 24-25, AY 25-26. Lot of changes were there in capital gains. Now, certain things have been normalized. That is, year afterwards, these sections or the percentage will be carried as that is, it will be carried in a usual way. So, this material, whatever this amendment material you can see, there are certain capital gain information for your purpose of understanding. Okay. For better understanding over here, wherever the amendment is there, I'll tell you that is the amendment. But there are certain changes. I have given a proper construction with. Okay. See, if you have come through so long of the video, and I'll tell you one thing, along with this, whatever amendment material you can see, the base material, whatever is there for the entire chapters of all the chapters, TDS, TCS, your set of carry forward, your deductions, everything, all the material is available. Amended material, which is applicable for your May 26 and your onwards examination, is available in the Telegram channel. You can go download over there, get a print, and then you can. Okay, that's all the free resources. Please make utilization of those free resources as well. Okay, all the resources, all the handwritten materials which you can see the year afterwards, all those things will be provided in my Telegram channel. You can find it over there. Okay, Telegram channel link is given here only, and my YouTube channel. However, you're watching the YouTube, so fine. Telegram channel link is there here. You can just click on that, or you can just copy paste that in Google. You will get the Telegram channel link. You can join over there. Okay, so now let's speak about capital gain. Very important aspect in the capital gain is the long term and the short term capital assets. The definition or the idea of that. The earlier it was divided into three parts, that is 12 months, 24 months, and 36 months. Now the entire concept of 24 months is the entire concept of 36 months is removed, excluding one point. I'll tell you what is that exception. As of now, you should understand that there are only two things which is available. Whatever the table which you can see over here, these are the changes from the last year to relevant year. It is, they have removed the point of unlisted shares or land and building as a separate category. Unlisted securities as a separate category. Other capital assets, it is 24 months, not 36 months now. The concept of entire 36 months has been removed except that one now. It's one exception to it, I'll tell you later. So whatever the points which you can see over here, the same table, wherever I have got it, I just removed those and I have brought up that this as a separate table, wherein this is for your understanding. If you have my old material, you can make these changes or you can cut like this, or if you want a new material, however it is there in Telegram, you will get it. Short term and the long term capital assets, it's been recorded in this way. If you remember this will be more than enough. Okay. Capital assets, short term and long term capital assets. How do you determine the capital gain? It is based on the capital asset. If the asset is long term, capital gain will also be long term. If the asset is a short term capital asset, then the capital gain arising out of it will also be treated as short term capital gain. Okay. See, if the security other than the unit listed, recognized to stock exchange, units of equity oriented funds and zero coupon bonds, these three categories, it shall be considered as short term capital assets if it is held for a period less than or equal to 12 months. If it is more than 12 months, long term capital asset, exactly 12 months, remember it is short term. If it is more than 12 months, it is long term. For every other capital asset, your jewelry, land, building, immobile property, mobile property, unlisted shares, all these points are covered under the definition of other capital assets now. Now, if it is held for a period greater than 24 months, it is treated as greater than 24 months, it is treated as long term. If it is less than or equal to 24 months, it is treated as short term. Okay. See now, that exception I told you, this exception is nothing but exception for the slum sale, wherein even now, even in this particular section of 50B, which you can see, section 50B, that is capital gains in respect of slum sale. Remember, is the undertaking held for period of greater than 36 months? Yes, it is still treated as long-term capital gain. If that undertaking is held for a period less than 36 months, then it shall be treated as short-term capital gain. That is, gain arising out of that will be considered as short-term capital gain. Understood? If the undertaking is held for a period greater than 36 months long-term, less than 36 months short-term. That is what this entire point of section 50B is about. As I've entered this, I'll also finish the other thing. After you recognize it as long-term capital gain, if you remember, we had this long-term capital gain at the rate of 20% over year. That is, if the transfer has taken before 23/7/2024, it was treated as 20%. If it is on or after that, it was treated as 12.5%. Now, the concept of if the transfer has happened before 23/7/2024, after it's gone, because now the PY which is applicable is 24/25, that is from 1st April 2024 to 31st March 2026. Hence, this point is not there. We can consider just a 12.5% in this aspect and close. There is no difference of 20% and 12.5. Now, the slum sale section 50B, as per this, it is only 12.5%. Clear? Okay. And the other points, all of us know what is there in section 50B. So, you can look into these points once. Okay. See, indexation concept or the importance of indexation is not so much year after, but still we have to know the concept of the indexation because there are certain parts where indexation is still present. Okay, the cost inflation index, every year you have the cost inflation index. Similarly, this for financial year 25/26, the cost inflation index is 376. Okay. So section 46A, which speaks about the buyback of shares, that is the capital gain on buyback of shares. Earlier, you had the difference, that is before 1/10/2024, on or after 1/10/2024. Now, the concept of this is removed. That is, before and after is removed. It is just for A by 25/26. We have this one point. All these points have been discussed in the earlier amendment video. This is the point which you can see is not an amendment. It is just an understanding. See, this was also not an amendment. This is also an understanding. But this is amendment. something is been added. That is for 25, 26, 376 is there. No, this is amendment. This is your understanding that you don't have anything like this. You just have one point, not subject to tax in the hands of the company for buyback of shares for the company. It is taxable in the hands of the shareholders in such particular way. Okay. The section 50B is also understanding it is not an amendment. Earlier this was there. Now it is understood that long-term capital gains taxable at 12.5% only for the slum sale. Section 110A, this is also an understanding which you have. See, long short-term capital asset, basically which was treated. You have four sections, brother sections if you remember, 111, 111A, 112, 112A. 111 is a separate, that is short-term capital gains as such. Let's see that. Let's look into these two, that is 112A and 111A. 111 speaks about short-term capital asset, basically on sale of equity shares, equity-oriented mutual funds, and the business trust for that matter. Earlier, you had before if it is sold 23/7, 24, it was 15, and after that it was 20. Now there is nothing like such. It is just for one assessment year. Assessment year 26, 27. It is just 20%. You don't have the concept of 15 or 20 because that dates are gone. Those are past. Now we have to look into the present situations in life. That is A by 26, 27. It is how much? 20%. Section 112. Understanding of the section 112 is very important. There is no amendment. It is just your understanding. Earlier, you had a difference of before 23/7/2024 and after 23/7/2024. All those things are gone. Now it is just one understanding. The transfer. Basically, let's consider, let's make the classification as two, that is individuals or HUF or other assets. For individuals or HUF, remember, still, even today, that is even in P by 24/26, that is in A by 26/27, they have an option where land or building or both land, building or whatever it is, both acquired before 23/7/24. Prior to this date, they have acquired it, purchased before this date, and they have sold after this date. That is in A by 25. That is in A by 26/27. They have sold. Thing is, they have purchased before this and they have sold after this date for that matter. Still, they have an option, that is, they can go for 12.5% without indexation or 20% with indexation benefit, whichever is more beneficial for them. It is totally up to them. Okay, it is totally. They have an option, whichever is more beneficial for them. Whichever place they are ending up paying less tax for that matter, they will take that, obviously. For other assets, other than individuals on HF, whatever the asset which they purchase. For other assets, other than the individual and HF, whatever the asset which they purchase, and for individuals and HF, the other asset which they purchase here as well. Okay, they have to pay how much? 12.5% without indexation. What is it? 12.5% without indexation. They don't have the option of with indexation. There is only a flat 12.5% without indexation. That is long-term capital gain shall be taxable at the rate of 12.5% without indexation. Clear? Yeah. Section 112A, which is the brother of 111A, where the long-term capital gain, you are paying the tax under this section for the sale of equity shares, business trust or the equity-oriented funds, and the capital gain is exceeding how much? 1,25,000. For A by 26/27, if you are getting that, it is 12.5% on the amount which is exceeding 1,25,000. There's no concept of 10% before, after, nothing. It is just one. A by 26/27, if you are selling it and you're getting a long-term capital gain which is classified under section 112, then go and pay 12.5% easy as such. Okay, this is also an understanding. See, section 54 EC, this is an amendment though. There are some additions which is made under the section 54 EC, wherein, see, all of us know section 54 EC is an exemption related section for the capital gain. If you have capital gain, you don't want to pay the tax for the entire capital asset for that matter, whatever the amount you're getting, you can reduce that by considering section 54 EC by making the investment in the sections which they are stating. If you are, and any assets for that matter, you can be individual, HUF, AOP, PY, company, any individual, and whatever the asset which you have transferred is land, building or both. It should be long term only. Land, building or both. It can be land or building. It can be land and building, but it should be long term. Whatever money which you are getting in from the sale consideration, basically that is from the capital gain, you should invest that money in the bonds of NHA or RECL earlier. and that too within a period of 6 months from the date of transfer, when you were getting what? Section 54 EC exemption, maximum of how much? 50 lakh. However, along with this NHAI RECL, the other bonds are also notified, that is HUDCO, Housing and Urban Development Corporations, and Indian Renewable Energy Development Agency Limited, issued on or after 9/7/2025, or any other bonds which is notified to the counter. These two has been notified over here under section 54 EC. Clear? So, people, these are the amendments or whatever we can see. The amendments are not so difficult. Amendments are easier when compared to the last year. But make sure that you're going through the entire thing. And if you already have my material, wherever the changes I have done, please do the respective changes. Or you can find the updated, this whatever I have written over here. Along with this written points, I will post the same thing in the Telegram channel. You can find that updated material also. It is as per your comfort. And if you have any suggestions with regarding to which videos you want to come up with, or if you want any particular questions to be solved or anything for that matter, you can post the comment, or you can text me over the Telegram also. You both of them, anything would be fine. Okay. So thank you so much. Study well. All the best.